Ever wonder how some people seem to pay so much less in taxes, even when they're making a pretty good living? It's not always about shady deals or offshore accounts. Often, it's about knowing the rules of the game and using them to their advantage. Today, we're pulling back the curtain on 7 tax loopholes that the upper middle class has been quietly using for years. These aren't secrets reserved for billionaires. They're strategies that are often hiding in plain sight within the tax code. Stick around, because understanding these could completely change how you approach your finances and maybe save you thousands of dollars each year. First up, let's talk about the Health Savings Account, or HSA. Now, you might think of this as just a way to save for medical bills, but it's so much more. It's what I call a triple tax-advantaged powerhouse. Here's how it works. First, the money you put into an HSA is tax-deductible, which lowers your taxable income for the year. That's win number 1. The second, the money in the account grows completely tax-free. You can invest it in stocks, bonds, and mutual funds, just like a 401k, and all those earnings, not a penny of tax on them. That's win number 2. And here's the kicker. Win number 3. When you withdraw the money for qualified medical expenses, it's completely tax-free. No other account in the US offers this triple benefit. The upper middle class maxes this out every single year, not just for healthcare, but as a stealth retirement account. After age 65, you can withdraw the money for any reason, and it's just taxed like a traditional IRA. It's a brilliant long-term savings tool, disguised as a health account. Next on our list is mastering the art of capital gains. This is a big one. Most people earn money, pay income tax on it, and that's the end of the story. But the wealthy and the upper middle class understand that not all income is taxed equally. There's a huge difference between short-term and long-term capital gains. If you buy a stock and sell it within a year, that profit is a short-term gain, and it gets taxed at your regular income tax rate, which can be pretty high. But if you hold that same stock for more than a year and a day before selling, the profit becomes a long-term capital gain. The tax rates on these are significantly lower for many people. It's 15%, or even 0%, depending on your income. By simply being patient and holding their investments for the long haul, savvy taxpayers dramatically reduce their tax bill. They're not just investing, they're tax-aware investing. It's a simple shift in timing that can lead to massive savings over a lifetime. Loophole number 3 is something called tax loss harvesting. This sounds complicated, but the idea is actually very simple. We all have investments that do well from time to time. That's just part of investing. Instead of just feeling bad about a losing stock, the upper middle class uses it to their advantage. They sell that losing investment to harvest the loss. Why? Because that loss can be used to offset capital gains from their winning investments. Let's say you made a $10,000 profit on one stock, but you have another one that's down $5,000. By selling the loser, you can use that $5,000 loss to reduce your taxable gain to just $5,000. This directly lowers your tax bill. And if your losses are bigger than your gains, you can use up to $3,000 of that excess loss to reduce your regular income, like your salary. It's a strategy of turning lemons into lemonade, or in this case, investment losses into tax savings. Let's move on to the 4th strategy, maximizing retirement accounts. You probably know about the 401k, or a traditional IRA. You put money in, get a tax deduction now, and pay taxes when you withdraw in retirement. That's great, but the upper middle class takes it to the next level. They contribute the absolute maximum allowed by law every single year, but they don't stop there. They also utilize what's called a backdoor Roth IRA. This is a strategy for high-income earners, who are normally phased out of contributing directly to a Roth IRA. They contribute to a non-deductible traditional IRA, which anyone can do, and then, almost immediately, convert it to a Roth IRA. The result? They've moved money into a Roth account, where it will grow and be withdrawn, completely tax-free in retirement. By combining a maxed-out 401k with a backdoor Roth IRA, they are creating massive buckets of tax-advantaged money for their future. The fifth loophole is a game-changer for anyone who owns a home: the home sale exclusion. This is one of the most generous provisions in the entire tax code. If you sell your primary residence, you can exclude a huge amount of the profit from capital gains taxes. For a single person, you can exclude up to $250,000 of profit. For a married couple filing jointly, that number doubles to a whopping $500,000. The main rule is that you have to have owned and lived in the house as your main home for at least 2 of the 5 years leading up to the sale. People use this strategy over their lifetime, moving every few years, building equity, and cashing out hundreds of thousands of dollars completely tax-free. It's a powerful way to build wealth without giving a cut to the taxman. Number 6 is all about business deductions. Many people in the upper middle class have some form of side hustle or small business, and this opens up a whole new world of tax deductions. The key is that you can deduct ordinary and necessary expenses related to running that business. This could be anything from a home office deduction, where you write off a portion of your rent or mortgage, to office supplies, software, business-related travel, and even a portion of your cell phone and internet bills. By turning personal expenses into legitimate business expenses, they effectively lower their overall taxable income. The trick is to keep meticulous records and ensure the business is a real, for-profit venture, not just a hobby. But when done correctly, it can feel like getting a discount on your everyday life, all thanks to the tax code. Finally, we have the 7th loophole: using real estate depreciation. This is a favorite among savvy investors. When you own a rental property, the IRS allows you to take a deduction for depreciation. This is a non-cash expense that represents the wear and tear on the building over time. Even if the property is actually going up in value, you get to claim this depreciation expense on your tax return each year. This expense can be used to offset your rental income, often making it appear on paper that you've made no profit at all, even when cash is flowing into your bank account. In some cases, it can even create a paper loss that can be used to offset other income. It's a powerful way to generate cash flow while legally reducing or even eliminating your tax liability on that income. It's one of the biggest reasons why so many wealthy individuals invest heavily in real estate. So there you have it, 7 powerful tax strategies that are completely legal and widely used. From the triple tax-free HSA and the backdoor Roth IRA to mastering capital gains, harvesting losses, and leveraging real estate. These aren't just tricks for the super rich. They are tools available to anyone who takes the time to learn them. The key takeaway is that the tax system has rules, and understanding those rules can save you a significant amount of money. Of course, everyone's situation is different, and it's always a good idea to consult with a qualified tax professional. But knowledge is power. The more you understand, the better you can plan for your financial future. Thanks so much for watching. If you found this helpful, don't forget to like, subscribe, and hit that notification bell so you don't miss our next video.